Dear students, welcome you to session 51, chapter Treasury Management, Financial Management, 6th semester BCom of Mangalore University. Chapter Treasury Management. In this session, let us understand the meaning of Treasury Management and the types of Treasury Management. The term Treasury is derived from public finance. This term is used to refer the government department that receives income and makes payment on behalf of the government. Actually, the role of such treasury manager is a passive role. It does not have an active role except ensuring the availability of cash. So, the role of a treasury manager is to manage the shortage and surplus of the cash. Now here, treasury management is defined as handling of all financial matters, the generation of external and internal funds for the business, management of currencies and cash flows, and the complex strategies, policies and proceedings of corporate finance. Now when I explain this, so we know that cash is the most important asset for a business organization and it is a non-earning asset. So the finance manager should take care to minimize the asset in the form of cash. The surplus balance of cash, if we have, it can be invested in liquid or short-term or long-term investment as per the policy of the company. So when we invest in such short-term or long-term investments, we receive earnings or interest from that. So the cost of the holding cash is the loss of the interest. That is, if we are having more cash in our hand, it means that we are losing an opportunity to receive the earnings from that. Thinking that we will be losing the interest, and if we keep very less cash in the organization, then the business organization will face various other problems, like they will not be able to pay back the creditors, or they may not be able to invest their money in various investment opportunities, or they may have to take an instant loan, or sometimes even this may lead to bankruptcy or liquidation or closure of the business. So cash management is considered to be an important aspect of financial management, wherein the financial manager has to consider the liquidity as well as the profitability of cash. Now when I say about liquidity and profitability, can say that treasury management is the efficient management of liquidity and financial risk in the business. Now the financial manager has to see that cash is available in the organization, that is, there is liquidity of cash. At the same time, idle funds should not be kept in the organization. It should be invested and there must be profitability. So the balance of liquidity and profitability must be maintained by the financial manager. Now let us see the different types of treasury management. There are two main types of treasury management system. They are the centralized treasury management and the decentralized treasury management. Now we'll see what is a centralized treasury management. Now under a centralized treasury management, the management of cash is done in the main office, that is the head office. We call it as the administrative office. All the policies and plans are made in the head office, and all the cash receipts received by various local branches or regional branches are deposited in the bank account of the head office, and all the payments are made by the head office through the issue of checks. Now imagine we have an head office in Mangalore and the branches of that particular company are located at Delhi, Trivandrum, Mysore and Baroda. In such a situation, it is the main office, that is the head office which is in Mangalore, which will be making the payments for the various expenses of all these branches, and at the same time all the branches will have to remit the daily receipts to the Mangalore branch, which is the head office. So it is called as a centralized treasury management system, wherein the cash management is done in the main office or the head office, and all the cash payments are made from the head office. All the cash receipts are deposited in the bank account of the head office. Now we have another system that is known as the decentralized treasury management system, which is exactly the opposite of centralized treasury management. Here the regional officers, that is the local officers, can collect and disperse the funds independently. They will be able to collect the receipts. At the same time, they will be able to make payments for the various expenses incurred in their branches. So this will avoid frequent remittance of funds to the head office. So the local branch can also raise the funds locally, so they can take the decisions quickly. So under this system, what happens is the local office will become more responsible and responsive, because they are managing the cash by themselves. That is, they are making payments for the various expenses, and at the same time they are collecting the receipts relating to the business. So we have two different types. One is the centralized treasury management and the second one is the decentralized treasury management system. Thank you.